Hello everyone. Today I'm going to work through the workbook efficientfrontier.xls, which was used during my lectures in the Columbia Certified Portfolio Management Program at earlier this summer. Before we get down to actually showing you what the plots are, I want to walk you through the data, through the indices being used, and what are we trying to do over in this workbook. So in this workbook, we are going to look at a universe of 8 different indices: S&P 500, the UK index, the French index, the German index, the Nikkei index, Hong Kong, Shanghai, and the Brazil index. So this is going to be the universe of stocks that I would be investing in. And in reality, what I'm going to do is look at an ETF associated with all of these indices and be able to create whatever I did on this workbook using the corresponding ETFs. Okay. In order to construct the efficient frontier, I need the mean return vector, which is displayed here, and I also need the covariance matrix, which is not shown on this worksheet. The data for all of this is here in this worksheet called frontier data. It's got daily returns on all the indices. So you see all the indices up here. From these daily returns, I can compute out daily levels. I can compute out the daily returns. From there, I compute out the monthly returns. From the monthly returns values, I can calculate out what the mean return is, which is up here. This is the same mean return which is sitting in the efficient frontier plot worksheet. I also need the covariance matrix or the correlation matrix. So here is the correlation matrix. It's called the diagonal equal to 1 because every asset is perfectly correlated with itself. The off diagonal terms tell you what the correlation, the cross correlations are. All of them are positive. It means all of these markets are positively related to each other. This matrix down here is the matrix of covariances. So the diagonal here corresponds to volatility squared. Given this data, now let's go back to the efficient frontier plot. What I want to do here is plot different kinds of efficient frontiers, try to understand the relationship of what happens to the efficient frontier if you change the mean value, modify the volatilities, and so on. So let's start with the most basic one. I want to first plot the efficient frontier with all the markets in place. So that's number 1. So I'm going to choose 1 here, and I'm going to click on this button plot. This plots the efficient frontier corresponding to all the markets. Now the color code over here tells you the blue line is the efficient frontier with all the markets. The green triangles are the various market locations. So this is the S&P 500, which has a volatility of 6.2% and a return of 3.89%, which is what corresponds here to 3.89%, and it's 6.2% over here. What the efficient frontier clearly shows you is that by combining all of these various markets, you can get performance which is way better than any of these markets put together. So let's say if I want to get a return of 3.89%, which let me see about here, you can get 3% volatility instead of the 6.2% volatility that you would get from the S&P 500. So it's better to combine, better to diversify, better to get the returns that we want. Okay. Next, we want to see what happens when we drop one of the assets from the market. So number 2 here, if I choose 2 here, tells you it's the efficient frontier without the US market. Before I click it, let's try to think about what's going to happen. I have dropped one asset from consideration. I have reduced my universe of assets. So what is it likely to do to our efficient frontier? What should happen to the efficient frontier is that any given return value, my volatility should go up. Why? Because I have less opportunity of diversification, and therefore I should expect to see less, higher volatility. So my plot should move to the right. So let's plot it, and there we go. So the plot has moved to the right. Why does it merge back to the plot as you increase the return values? Because as you're increasing the return values, you are probably diversifying more over these emerging market assets. So whether the S&P 500 is there or not there in your market, it's the same story. Okay. Next, what we want to do is sort of investigate what happens when you change the mean return and the volatility. So here I'm modifying all of these mean return by 2%, and I want to see what happens to my plot. So let's clear the plot here for the moment so that we can see clearly what the modification of the mean is going to be there. So I'm choosing 3, which is efficient frontier with the modified mean and variance. I'm not changing the variance, I'm only modifying the mean. So if I plot this, here are the 2 limits, and just to make it better, I'm going to plot the internal one. So if you look at what's happening to the plot, I'm changing the means by 2%. That is 200 basis points. And here, if you look at what happens to the return value, so at a particular value, let's say about here, which has got about 5.8% volatility, the lower bound is 25% return, and the upper bound is 30% return. So it's magnifying the returns by about 2 to 3 times the mean. This is a nature of efficient frontiers. When you modify the mean, because we are trying to optimally select the various portfolios, it ends up trading off the portfolio and amplifying the errors in the mean. Why is this good or bad? Remember, all of these data has been estimated from historical returns. So this blue line, this dark blue line that's in the middle, really is an estimate. If the means were to go up or down by 2%, you could be anywhere in this interval. Suppose you thought that this was the upper envelope is the right interval, and you decided to be at that point. And you expect to get 30% return for a volatility of 6%. Really, in the market, you could be anywhere in this entire interval, and therefore you could get as low as 26% return. So that's something to worry about when you use efficient frontiers, and it's something that one has to take into account what happens with that. Finally, in this workbook, we have the option of just constructing an efficient frontier using 2 markets. Here we're going to do it with the Shanghai and the Brazilian one. These are these 2 yellow marked one. Why do I care about that? Well, if you plot it, you get that the efficient frontier goes through both of these assets. This just shows you the fact that the efficient frontier can be completely recreated by looking at 2 mutual funds. And here, because we are looking at 2 mutual funds, which are the 2 indices, the efficient frontier needs to go through that. So those are the capabilities. To summarize, I showed you what the data was. There are 4 different modes in which this plot can be done. The first one gives you the efficient frontier for all markets. The second one gives you the efficient frontier for the US market. The third one modifies the efficient frontier by changing the volatility in the mean. And the fourth one is simply a sanity check exercise to make sure that the efficient frontier goes through the 2 different assets that you have put into your portfolio. Thank you very much.